What's up, guys? Mike Sharp here. This is Sharp Investing, and this is the year-end 2025 review. Now, I've been doing this channel for 4 years now, which is amazing. I feel like it hasn't been that long. But what I do every year is I explain that my goal here is to track my results and my activity over 5 years, and if I can beat the market, then I will consider continuing to invest my own money fully. If not, then I'll just buy an index fund or find a manager that can beat the market. But I've got 4 years worth of results, which I will show you. I've also got, I'll go over some of the things that worked, some of the positions I have. I'll talk about my portfolio. And I'll also do a want list. I've got 3 stocks on my want list that aren't quite in my buy zone yet. Really good businesses. They're just not the price I want yet, but I will let you know about those ones. Yeah, so anyway, thanks for watching these videos. I really appreciate that I've got such a great audience, and hopefully you get something from this video. There might be some investing lessons for you to take away here. Okay, so let's look at the results. 2025, great year. This is my best year since doing the channel. I was up 41%. That is versus 17.9% from the S&P 500. The total return, which is an outperformance of 23.2%. So good year. Great year. I'm quite happy with that. And also my portfolio is the biggest it's ever been, obviously, because it's growing. So the total dollar value was easily the biggest I've ever had. Now, I don't know how I did before 2021 because I didn't keep good records. It's possible I had a better percentage year, but who knows? Smaller portfolios, so it doesn't matter as much. Basically, you can see over 4 years here. These are my results. As a reminder, I started this channel right at the top, at the end of the 2021 craziness. So there was a bear market that happened immediately after I started the channel. But that gave me a little bit of a lead on the S&P because my portfolio was quite defensive at that point, and beat it by 9%. So we have 3 years of outperformance and 1 year of underperformance, which was last year. And I kind of think that 25 and 24 might need to look at those together, because a couple of my big positions that didn't do well in 2024 and ended the year low did really well in 2025, so you might have to sort of balance those two. But bottom line is the portfolio has doubled over the time I've been doing this channel for a 19.4% CAGR. That's an outperformance of 8.3%. I am extremely happy with that. I didn't expect that would be possible, but I am quite happy that after 4 years we're getting a pretty good sample size. So I may be adding value. Now, first of all, some notes here. If you want to follow me on X, sometimes I post stuff that I don't talk about here. That's at @SharpInvesting1 on X, and feel free to hit the like button and subscribe. Now, I also want to do a cautionary PSA. Do not copy what I'm doing or what anybody on YouTube is doing. And I'll tell you why for sure from my perspective. Like on this channel, I'll show you what I buy most of the time, not all the time. Like I didn't post Applovin or Nubank when I bought those. I posted Applovin a bit later, but really, this isn't a real-time service, and mostly I don't even post when I sell. So if you don't know when the person sells and you want to be a cloner, that's a big problem, because where you make the money, in my view, is in the selling, right? What's actually, as the saying goes, the money is made in the sitting, but you actually confirm your wins when you sell. So if you don't know when the person sells, I really highly recommend not coattailing on anybody else's investing. Also, the other reason why you wouldn't do that is because you don't have the conviction level, right? If you're just buying something because somebody else bought it and it goes down, you go, oh no, what do I do? It's down, what am I going to do? But if you bought it because understand the business, and you don't mind it goes down, you have a plan, you can buy more, all that kind of stuff. So really, I really suggest just doing your own research and using videos like this as reference point to maybe learn something. Okay, so I would also, final cautionary tale is my portfolio. I can't guarantee that it'll do well in a bear market. There's a few positions I have that I think are going to get murdered if the market collapses, right? I've got KSPI, Stoneco, Applovin. These will probably all get crushed for various reasons. Not because they're not great businesses, but just because of the way the market is. And something like Vistry would probably also get killed because it's cyclical. Okay, so what am I doing here on the video, or on the channel, and what's my investing goal? Really, all I want to do is find one great business a year that I can hold for 3 to 5 years, and the goal is to either get a double in 3 years or have the visibility to get a triple in 5 years, right? Because if I find something like that I can hold for that long and leave it, I can sleep pretty well at night. So my ideal business is a small cap. I like small caps because they can benefit from more coverage and more fund inclusions as they get bigger. Also, it's easier to double or triple when you're smaller, right, than buying something like Microsoft that's already enormous, right? My key metric, I don't use this religiously, but the concept is the PEG ratio, right? So I want a growth rate that is double or more of the PE ratio, right? So that would be a PEG ratio of 0.5 or less. Now, that's not a hard and fast rule, but what that does is it gives me a margin of safety if the growth rate comes down, because over time companies' growth rates shrink, and it gives me a margin of safety. When I talk about PDD, you'll see what happened with that one and why this is a good policy. So also growth. I've been doing this for quite a while. I've been in the market since year 2000, and I got blown up in the .com bubble. But more seriously in the last 12 years. And when it comes down to it, my investing style is getting a lot simpler and a lot clearer. I just want growth. If the business does not have substantial growth going forward, that's a growth rate, a percentage rate, and a runway, I'm actually not that interested. I don't really have much interest in like mean reversion value codes that are growing at 5%. I don't really have any interest in that stuff anymore because I think it's much harder to make those work. And I just don't have as good a history of success on those ones. All right, so that kind of stuff. I like shareholder focused. I like buybacks in case, really active large buybacks in case the stock falls. Then there's a cushion underneath it. That's something like Stoneco has that. Kaspi seems to be building that. So that I can benefit on the downside as well. So I can feel good if the stock falls or if it goes up. And obviously it has to be a great business, a moat or a good competitive advantage that keeps out the competition. Okay, so let's look at the portfolio here. Now, one of my goals here is to not have a huge amount of turnover in my portfolio, and I'm getting a little bit better at that. I did sell 3 positions over the last year. One of them was Nubank. Actually, I'm going to go to the chart here. So Nubank is, we'll start with my mistakes. So Nubank was the biggest mess up of the year. And I did the same problem. I did the same thing twice. So I bought it back here. When was this? Early 2024. Trimmed it a little bit. And then right around here before the Trump tariff stuff, I said to myself, if it gets down to $10, I'm going to buy more, right? Because I just missed it here. I said, if it gets to 10 again, I'm going to buy it. And what happened? It got killed in the Trump tariff sell-off, and I sold it. And that was because, well, I'll tell you in a minute. And then I rebought it here after it kind of broke out of this thing and bought a little bit more there. And then I sold it back just, 2 months ago. And it continued to go higher. So if I hadn't just screwed around with this position, I would have done a lot better. It would be a double in 2 years since I bought it at about $8.50, actually a little bit more right now. But instead, I've got less of a return because I sold and I screwed around with it. Now, the issue with Nubank for me is that I learned a lesson here in that it is a great business. I love Nubank. I love the management. I love what they're doing. Huge growth rates. The problem with it is expensive for being in an emerging market, right? It typically trades around 25 to 30 times earnings. And my fear was in both of those scenarios were if the market collapses, then what's going to happen is, especially, and it's a bank too, so the things that are going to do the worst in a global recessionary crash type situation, emerging markets, banks, and expensive stuff. And it had all three, right? And so I realized in that scenario, I can't hold those kind of companies just through thick and thin, right? The rest of my companies, I didn't mind holding them, right? And I learned that. So I prefer to buy Nubank after it's been beaten up, so I'm really hoping it will get its ass kicked at some point because it's really fantastic business and I love the CEO. So that was the one I sold. PDD also sold this one during the year, and I was talking about the growth rate and the margin of safety that the growth gives you, right? So it was growing at an absurdly fast rate for the PE that it was selling at, and what happened is the growth rate went away, and I saw that for 2 quarters in a row, and I said, okay, well the growth rate's gone. The company doesn't give you any information, right there, and you know, like, I don't know where I'm at with this one. The growth rate was the margin of safety, and that went away. So I sold it. I didn't put a note here when I sold it, but basically you can see where I bought it. I did a video at that point, about 70 bucks. I added some more on the way up, and then I sold it, I don't know, somewhere in here, I think. Anyway, I made about 50% on it, even though the margin of safety went away. And the margin of safety protected me because what happened is the growth rate pushed the stock up over time, and that's why I love the PEG ratio. So that one was a winner, but it's gone now. Ecopetrol, I also sold. I won't really talk about that one, but I got rid of that one just basically because I had better ideas for it. So if we go back to the current portfolio, what we've got here is you can see it's pretty concentrated right now, and I don't have that many positions. So I'm hoping to add some positions this year, and actually my cash percentage is at 25%, which is more than I want it to be. What I do is I trade actively with that portion, and I'll tell you how I did with that money. But basically, flow traders, almost 20%, Vistry almost 20%, Applovin's 10, Stoneco is 8, KSPI's almost 8, Full House 5.5. I've added Lululemon as one of these sort of investment trades. It's not a high conviction position, but I do think the brand is fantastic, and I do think it could potentially catch a bid here, just based on the brand, the quality of the business. I mean, they have just massive return on capital. They have massive margins, and if the growth rate starts to come back in the US, I think that's going to fly. If we look at Lulu here, so basically I bought it after it broke out of this little box here. I'm gonna get rid of the volume so you can see I bought it right there when it popped out, and then it went back in, and now I'm still holding it. But my idea is that might be the bottom, and if we get the next earnings report look good, you could see one of these kind of things. So I'm basically just gonna try and ride it up if it goes up. If it comes back down here and starts looking weak, I'll just get rid of it. It's not high conviction at this point, but I am researching it. Let's go over a few of the things that worked this year. Flow traders. Flow. Whoops, that's not going to be the right one. Flow traders. Where is it? This one. Okay, so what's happened with flow traders is it came all the way down here in 2024. I loaded up here, and then we had this nice run up, and I trimmed part of the position. I think I talked about it in one of the videos at about 2750 or so. I cut about half the position I had on, and just recently I've re-added down here, and you know, you can see. Let's do how did it do over the year? So about here to about here. Oh, where's the end of the year? So it's up, you know, 15% or so. Didn't have a great year, but because I was able to avoid this chunk of the downslide by trimming the position, and actually added more. I have a bigger position than I've ever had now because I have my conviction levels really high on this one. But just saving that bit actually pushed the returns on this particular stock up over, you know, 20%, 25, I think, something like that. But that's some of the value of understanding the personality of your stock and how it responds to earnings and how it responds to future earnings, and just charting it, right? I believe in charting, and I think it works. And in some scenarios, it does me really well. It doesn't always work, but in this scenario, it does. If we look at Stoneco, same kind of thing. This year they had a phenomenal year this year because it ended last year right on the lows. It was right about here, and as of today, we're up, you know, 85%. I think probably end of the year was about the same. Yeah, it's about about 85%. And what happened was I was able to buy some down here, and then I sold some up higher. I did a video when I sold some of it, and now I'm looking to buy back. I would actually load up pretty strongly if it got down to the $10, $12 range, but I'm just waiting. I think it's in no man's land. But basically, this is another example of trading around the position to give me a higher return than I would have received just by sitting on this. Now, I know I talked about Nubank, which is the opposite. I screwed around in the wrong way there, but on balance, this strategy seems to work for me. The Nubank sale was more of a fear, and these are just, knowing where the resistance points are for the stock and knowing where it's a good value. Basically just rebalancing up and down as it goes up and down. So if you get, that's one of the lessons, maybe you can take from this. If you start getting good at knowing the personality of your stocks, you can add a few percent here and there to your returns. Good Applovin, also another winner this year. This has been it's definitely my best result ever. I mean, it's up, what is it up? It's like almost 1,300% since I bought, but you can see I've been trimming on the way up. I did another trade where I bought and sold there, and this year, what has it done? I remember calculating, it's a lot, something like 100%, I think. So if we just kind of eyeball it here, where was the end of the year? It was actually before this fall. So it's about 100% on the year. Now if I had done better if I hadn't trimmed these, but I'm comfortable with that because the position was pretty big, and every time I got over 20% of the portfolio, I kind of trimmed it down, and then I cut some more up here somewhere. I can't remember. But what I've also done, and I've started to add to my repertoire here, is selling calls on stuff that's more expensive than I feel comfortable. And that's where Applovin is. But I also don't want to sell it because some of the other lessons I've learned in the past is I've sold stuff too early, and then it just keeps going, right? Go back to Meta. I bought that like almost on the bottom tick, and I sold it way too early. It like still doubled after I finished selling. Probably went up another 100. It doubled plus some after I sold it, even though I had already got a double out of it. So that was a lesson that I'm trying to just stick with. And I've realized that if I have stuff that's overvalued, but I still think it's a great business and want to hold the shares, I can sell calls on it. And I've done that twice here, which has added $65 per share to my Applovin position, right? So that's added over 10%, I think about 11, 12% on the current price. And that is since September. So we have 4 months of just adding 11% of income there, and I still haven't had to sell it. I still have one open at $800. So if the price goes above 800, then I'll have to get rid of it. But I don't think it's going to get there within the next 5 weeks or whatever it has till expiry. So anyway, that's an idea. That's something I like. I'm going to keep in my back pocket now for stuff that I want to just hold on to. And just generate some extra income from it. If it falls, Applovin, I'll just buy more because I think it's a really, really fantastic business. It's just very expensive at the moment. So if we go here, my other biggest position is Vistry. Now Vistry, I have high hopes for in 2026. You can timestamp me. I think this is going to, there's a few things here that I really like. We've got this base building here, and I think if this pops out, we're going to go on a ride. I think this is going to just fly once it gets out of there. And there is a catalyst. The earnings should start to inflect in 2026. They have had this massive change in funding from the government on their projects, and they're basically the only big provider that will do the projects that the government needs. So I think there's going to be a huge inflection here at some point, assuming we don't have an economic collapse in the meantime, because if there is, they'll get nailed by it. All right, well, let's look at my want list for 2026 so far. I'll find some other ones as I go along here, but basically what I'm trying to do is I just try and get through learning about 50 businesses a year, and I shortlist them by stuff that I see online, other people who I respect who come up with ideas. I'll research those, so they've already been filtered. It's not just 50 random stocks, right? So that's kind of my goal. Sometimes I get stuck on them, and researched for a long time. But one of the ones I did a video on was DLO. I think this is a phenomenal business long term. It is just not in my price range yet. I hope they have a bad quarter at some point. But they're basically a payment processor in emerging markets and a toll booth for a massive amount of transactions that are going to be going through them, over the next 10 years. And the growth rate is very fast. The tailwinds are huge, and I think pretty low risk as well. Just not cheap enough because I'm a cheap ass, right? So DLO is one I'm keeping an eye on. ZETA, I'm sorry. I did have it, and I unfortunately got rid of it, and it looks like it's just popped out. Now this is based on their 2028 targets. I don't think there's a huge amount of upside in terms of fundamental, not fundamental, but basically I don't think there's a huge amount of upside in terms of valuation just based on what their targets are, but it's a really good business, and I'm just waiting for my pitch on that one as I research it. Another one I'm looking at is Nintendo. Now, I'm a little bit closer to purchasing this one after this nice collapse here. Now, Nintendo has a moat. Like, the word moat gets overused, I think, but they have a moat. They have an IP moat that you cannot touch, right? All those, Mario, Zelda, Pokemon, all these franchises that you can't hurt them even if you try, right? The only person who can hurt Nintendo is Nintendo if they screw up their games, but they generally don't because they have very high quality software and they really protect their brand. But it was very expensive going into the Switch 2 release, and now we're getting the post-Switch 2 doldrums when people realize it's actually going to take them a few years to fully monetize that new platform, the new console. So I might dip my toe in if we get down in this range, the 13, 14 range, maybe 12, I might be a bigger buyer. It's not cheap at the moment, but the quality of this business is very high, and I'm almost positive that they will still be on Earth and just plowing in the cash in 40 years from now. So Nintendo really keeping a close eye on that one. And then so finally, what's the plan for 2026? Basically, I'm trying to, I say this in these videos, I try to do less, as Charlie Munger says, and that's why, Charlie says that him and Buffett have beat the market over the long term. They just do less than other managers. I'm really trying to do less. I did have 3 sales this year, which is kind of more than I want. But, I'm getting better and less trigger happy with my mouse. So I'm going to try and research 50 businesses, and my goal is to find one small cap with growth over 20%, peg under 5, great moat that I can leave for 5 years or more. And also I should mention with that big cash pile I've got right now, basically what I've done is I've used that as my discretionary trading capital, and that portion of the portfolio made 25%, which was good this year. But I have one account that I don't include in these results, which is sort of a CFD account. Those are like synthetic futures that I made trades on, did a lot of my gold and silver trading, and if I included that, my trading results would have been about 70%, right? So I've done really well in my trading, and I feel okay to have that much cash because I feel I can generate more income with it. But like I said, I do want to deploy it. I don't like being more than 20% in cash. And ideally, well, not ideally. Ideally, the market crashes and I can go 100% invested. But I don't. Part of the reason I have that much cash is because the market's really expensive right now. And I don't feel comfortable being fully invested. And what the trading does is it allows me to. There's short-term trades with stops, and if the market starts crashing, those will all just get liquidated, and I'll have a pile of cash to buy things with, right? So that's sort of why I'm doing that. But if the market did crash, I would just put it all in long-term investments. All right, so I think that's it. Again, just looking for one small cap that can kick ass over the long term, has a long growth runway, has high incremental margins. You know I love margins. And ideally some high return on capital too, if that's a relevant statistic. But for now, feeling good about the portfolio and feeling good about 2026. But got to keep your eye on the ball. This could all go the wrong way if there's some change in the political universe or the financial universe. So can't count your chickens before they hatch. I have 1 year left until we get to 5 years at this channel, and then we'll see how I'm doing. And hopefully I don't blow my lead. All right, guys, thanks very much for watching. Catch you in the next video. Thanks for watching.